There's really two issues that we have right now. One is the supplemental leverage ratio and the issue of whether customer initial margin is actually included such that it reduces the exposure of the clearing firm, as it certainly well should. And then separately is the risk-weighted asset calculation, which is unfortunately done on a gross notional basis and therefore doesn't reflect the true net risk of the customer positions in a clearing member's portfolio at a CCP. Those are two issues that we're working very hard to try to tackle, both with the Fed and banking regulators, but also with legislators. But the other aspect of that for us is just making sure that as we're going through a lot of change in how we size our clearing fund and looking at all of our different kind of margining methodologies and margin models, just making sure that, one, they're appropriate and they're prudentially oriented, but also making sure that they're efficient from our clearing members' perspective. Our first and foremost responsibility is always to make sure that we have adequate resources, but to the extent that we may be over-insuring, we have to be cognizant of that too, because the cost of capital for our clearing member firms is enormous, and this has become an increasingly less attractive business to be in terms of providing agency broker clearing services. It certainly is the case that SACR would be a better methodology in terms of addressing the sort of risk-insensitive nature of the current exposure method. But the problem with that is that even if they get to proposing something by summer, it's likely to be, we would think, a couple years, maybe longer, until something like that is ultimately implemented, especially recognizing that there'll be a lot of divergent views on SACR itself. And the industry will have certainly a lot of opportunity to raise those issues. So we have been trying to, get the banking regulators to focus on some kind of interim relief that would give some greater recognition of the true net risk of the exposures versus the gross notional value. That could be done through a interpretive relief or through a kind of narrowly tailored rulemaking, and we're still very much hoping that we can achieve that. There's also certainly the potential for very narrowly targeted legislation that perhaps could address that as well. The issue is SACR is probably an effective solution, but the capital constraints that are affecting bank-owned clearing member firms and by extension large market makers in the equity options markets probably can't wait until that's implemented, because we're seeing reduced clearing capacity in the industry. Clearing firms are not willing to provide so much balance sheet to their customers. Customers are having to restrict their trading activity and liquidity provision in the market, and that's not healthy for the ecosystem. So this is something we feel very strongly about. We do think there's a path to more narrow short-term or interim relief. But in the end, it's going to be a decision that the Fed and the banking regulators have to make.